Hi, Gabriel Josiah here again. Okay, we'll be discussing. We've been discussing on profitability ratios. The last class we looked at return on capital employed. So right now we'll be continuing on that same discussion, and today we'll be looking at return on equity. Return on equity. So let me quickly share my screen so we could delve into return on equity as quickly as possible. Okay, so return on equity is a variation of return on capital employed, but it concentrates on the entity's equity. So it has nothing to do with dilution of the capital. So the ROCE incorporates the internally generated funds and that of the external generated funds combined together is a total of the capital. But the return on equity concentrates on equity holders, internally generated funds or owners of the business. It's also referred to as common shareholders or common stock owners. It also compares the equity capital with the amount of profit which is attributable to them. Now the formula is calculated as the profit after interest, after you've deducted your tax, after you've settled preference dividends divided by only the ordinary share capital plus reserves, only the ordinary share capital reserves. So I take that again, the profit after interest, after tax, after preference dividend, and also you express that against your ordinary share capital, your reserves, share premium, retained earnings, or whatever it is that is attributable to the owners of the business. So let's look at an example here graphically with the same shareholder tool we have been looking at. So our profit after tax is given here. You see we've deducted for the interest for external holders. We've added back our finance income. We've also deducted depreciation, amortization, and every expense that has to do with the business. So we are looking at the bottom line, which in this case is our net profit or our profit after tax. So I take that and I post it as 70 million naira. Made 70 million after tax. So don't forget, we have to settle preference shareholders who have a claim on our business. So our preference shareholders dividend has to be settled, but in this case, their dividend is 0. So the preference shareholders will be settled and provided that for them, but unfortunately for this year, or fortunately for us for this year, there is no amount for them. There's no dividend declared for preference shareholders, 0. It's the amount for this year. And we have a profit after tax, which is still 70 million naira. Now let's have the denominator, which we get from our statement of financial position. So we only take our share capital, share premium, and our retained earnings. So this belongs to internal shareholders. So we're not taking the preference shares in the case of the ROCE or bank loan or non-current liabilities. So we just take this to express our denominator. So we have a total here of our profit after tax, and we have a total here of our ordinary share or shareholders funds. It's called shareholders funds. So we divide our profit after tax by our shareholders funds, which generated 9% in return. So our return on equity is 9%. So our ROE for 2020, based on the financial statements, is 9% generated, which is fair enough, and it's also positive. So going back to our formula, you will see that the return on equity deals with just equity of ordinary shareholders alone. So it's a key profitability ratio which measures a company's ability to generate profit from its shareholders' equity or shareholders' fund. Like I stated earlier, it also reflects how effective the management is using equity or common stock financing to generate profit or earnings. It also means that the profitability of the company in relation to equity held by shareholders is generating returns. It shows how much profit the company generates with the money invested by its shareholders, highlighting the effectiveness of management in utilizing shareholders' funds. So we have the net income, or the bottom line, which is our net profit after we've deducted expenses, taxes, costs, like we have seen graphically in that example. Then we have the denominator, which is our shareholders' funds, which is the total equity injected by shareholders, which includes retained earnings. So what's the implication? So a higher return on equity suggests that the company is effective at generating profit from its equity or internal shareholders. It often indicates strong management performance and can attract investors looking for good returns. While conversely, a lower return on equity might signal inefficiencies, but that the company is not effectively using its equity to generate profits. It could raise concerns among investors regarding the company's operational efficiency, especially the shareholders and the owners of the business. So external financiers are just investors from afar, but these are the owners of the business, and a low return on equity, it's a cause for concern. It shows you wasted your investments if returns are not generated substantially to cover investments. This is very critical. So what are the causes and effect of a positive or a negative return on equity? So the causes for the positive is a strong net income growth due to effective sales strategy, cost management, or market conditions. So where a return on equity is positive and high to some extent, there is potential that sales strategies are effective, there is good cost management by the management team, and the market conditions are favorable for the company. Efficient use of assets is also a cause, and managing expenses leading to higher profitability is also a cause. Reduction in the equity base through share buybacks, retention of earnings are also causes, which can boost the return on equity without increasing net income. This is very important. While the effects is a consistent high return on equity can attract investors and lead to higher stock price. That is the stock market or the stock exchange, where the value of the ordinary shares could be very high and attractive to investors. It also indicates strong financial performance and confidence of investors in that company. Also shows efficient capital utilization. While conversely, a declining return on equity may prompt management to review operational strategies, its cost structure, and consider restructuring the company to improve profitability. So in conclusion, return on equity is a vital parameter for assessing a company's financial performance, especially where it has to do with ordinary shareholders, and the effectiveness of management in utilizing shareholders' funds. It serves as an important indicator for investors when evaluating potential investments and the company's growth prospects. So regular analysis of return on equity can help stakeholders make informed decisions regarding their investments and the company's financial strategy. This is very, very important. So looking at the return on equity will help us understand how the owners of a business aside other dilutions or external capital providers, generate returns and grow the business over time, see their investments grow, that what they've invested is coming back to them in returns and positively. So thank you very much for this class. Let me know what you think in the comment section. Let me know your observations and your comments. I'll address them if you have any vital questions or disturbing questions. Don't also forget to like, share, and subscribe to the channel so you'll be notified when new videos are posted. Thank you very much and see you in the next ratio class. Bye for now.